When I was first learning to trade almost 2 decades ago now, I was fascinated by all the common rules that traders shared. It almost felt like I was entering some sort of secret club with this special code of conduct, things that all traders should or shouldn't do and what certain things in the market meant. But as I learned more and started to succeed on my own, I soon realized that most of these things were just the equivalent of people sharing bro science down at the gym. You know the type I mean? Things that aren't backed by any sort of evidence or logic. It's just what everyone else says to do and everyone else does it, so you kind of just follow along. So this obviously meant that over time I ditched most of those rules, as I'm sure you have or you will do at some point in the future. But there are some of them that I've kept hold of, and one of those is the 2% rule. So this is the rule that states that you never risk more than 2% of your capital on any trade. But if you ask people why they do this, or try to find good reasons for it online, you don't get a good enough answer. You'll basically be told it's to protect your capital. But that shouldn't be a good enough reason on its own. We need to know why. So let me share my reasons with you, and maybe that will help you to make up your own mind and decide how you want to deal with this rule, whether you want to follow it or not. Now for this, there are 3 things I want to cover. There's the number aspect, the psychological aspect, and the neurological aspect. So let's get started with the numbers. Ultimately, the reason for protecting your capital is in case your trade loses, obviously. Otherwise, there's no need to protect anything. Now, if it was just one losing trade that we were worried about, it wouldn't really matter if we were risking 2%, 5%, 6%, whatever else. Instead, the important thing is whether you actually go on a losing streak, where you lose a few trades in a row. So a lot of traders can feel overconfident about losing streaks. They think they might lose a few trades in a row, but a big losing streak, losing one trade after another without any profitable trades, they think that's unlikely to happen. So let's actually take a look at the probabilities for that and see how likely it is. Imagine you open 100 trades a year, so that's about 2 trades per week. And let's say you have an amazing success rate with 70% of your trades being profitable. So out of every 10 trades that you open, you profit with 7 of them and you lose on only 3. What a phenomenal success rate that is. In this case, the chance of losing 5 trades in a row at some point during that year, during those 100 trades, is 15.26%. The chance of 4 losses in a row is 43.26%. So there's a decent likelihood that it will happen, but it's not massively high. But you can assume over the years it will happen. But here's the thing. Most people don't have a 70% win rate, at least not if they're using asymmetric risk returns in their favor. Instead, below 50% as a success rate is much more reasonable. So let's put it to the higher end of the scale and say that the win rate is exactly 50%. So in this case, it means that the chance of 5 losing trades in a row sometime during that 100 trades in the year is now 81%. In fact, the probability of 6 losing trades is nearly 55%. And honestly, for most profitable traders, a 50% success rate is actually on the high side. So I think it's fair to conclude that the chance of having at least 5 losing trades in a row at some point in the year at just 2 trades per week is fairly high for most people. And if you trade more than 2 times a week, if you have more than 100 trades in a year, the chance of it happening is even higher at some point during that year. So what does this mean for your trading account? Well, let's say that you risk the maximum 2% for every trade. So you max out your 2% every single time, which by the way, I wouldn't recommend doing because we always encourage you to use dynamic position sizes. And if you don't know what those are, you can find a video linked up here that will explain all about dynamic position sizes for you. But basically, if you risk the maximum 2% every single trade and you lose 5 trades in a row, you obviously have a drawdown of 10%. Quick maths. So this means that if you want to get back to break even, your account is now 90% of what it was before, you need a return of just over 11% to bring it back to break even. Not such a big deal really. If your returns are always larger than the amount you have at risk, this can be achieved with just a few profitable trades, as long as you don't lose any more trades in the meantime, right? So that's pretty straightforward. But what if, instead of risking 2% per trade, you now risk 3% per trade? Well, now, after 5 losing trades, the drawdown is 15%. So that means you're going to need a return of 17.6 to get back to break even. And what about if you risk 4% per trade? The drawdown now is 20%. I know I'm impressing you with my mental maths here, but that's going to require a 25% return to get back to break even. And what if we jump all the way to 10% per trade, which I know sounds crazy, but you'll be surprised how many traders I see doing that without maybe even realizing sometimes. So after just 5 losses, the capital is obviously half gone. And this means that you're going to need to double the account just to get back to break even. Now, if we were only interested in probabilities and statistics, we might choose to use something like the Kelly criterion, for example, or some other alternative to calculate our ideal amount at risk. We could calculate our success rate over the 100 trades in a year and see what amount we should risk per trade. But the fact is, probabilities aren't all that matter. Firstly, our success rate may vary depending on the different types of setup that we have, or different times of year, different market cycles. And secondly, and perhaps even more importantly, is that we are not robots. Right, what do you think is going to happen to a trader whose account is down 50% and they know that they now need to double the account just to get back to break even? What do you think is going to happen? Well, they're going to start taking bigger risks. They'll be increasing their position sizes, forcing trades so that they can increase the number of trades that they open, revenge trading, holding trades for too long, hoping for more profit, getting greedy, and being unwilling to close at a loss when the time is right to do so. So in other words, what they're basically ending up doing is gambling. And let me tell you, in my experience from seeing this happen to many different traders, it tends to happen a hell of a lot sooner than at a 50% drawdown. Everyone has a different threshold, but it really doesn't take much of a loss at all for all of this to kick in. The stress and pressure builds up, and traders have much more of a willingness to take risks when they're trying to get back money that they've just lost. And this has actually been evidenced in countless studies, which if you want to, we can go into in another video at another point in time. Just let me know in the comments and I'll add that one to the list. But you know, it's not just about the drawdown from a losing streak either. It's also about how we act with individual losing trades even before we close them as a loss. So studies from Kahneman and Tversky found that we value losses about 2.3 times higher than gains of the same value. And a study by Baumeister found that that actual number was probably closer to 5 times. So we value losses at 5 times higher than gains of the same value. So this leads to us encountering loss aversion, which I've spoken about a lot on this channel, where we're more willing to take risks or go through undisciplined actions to avoid taking a loss. So the bigger and more meaningful that loss is, the more that loss aversion is going to kick in for us. So when we risk lower position sizes, we're still going to encounter loss aversion to a certain extent, but it's just going to be relatively less powerful than if it's a bigger amount, which means that we're more likely to be able to take appropriate decisions that are in line with our system. But as that loss aversion gets heightened when the loss is bigger, we start taking risks to avoid taking the loss. We'll do irrational things like moving our stop loss as the price approaches it, or doubling up our position to get a better average entry price, hoping that the price, doesn't have to travel as far to get us back to break even. But by taking these sorts of actions, it means that once we do eventually take a loss, it ends up being much bigger than we first anticipated. So rather than risking less than 2%, we don't just risk the amount more than that we originally planned, we actually end up risking exponentially more because of our own psychological flaws, leading to this loss extending and getting bigger and bigger. Now, no one likes to accept that they have any weaknesses, so you might be thinking that you can probably overcome these things just by strengthening your mind and improving your self-discipline. But actually, it all goes a bit deeper than just being able to do that. There are plenty of ways that trading affects our brain and our bodies, and when it comes to the brain, neuroscientists are discovering more and more about it every year. There's so much they've already found out, but actually there's still so much that's relatively unknown. We could talk about it for hours, but for now, I just want to read you something from the neuroscientist and former Goldman Sachs trader, John Coates. So he says, "When we take on risk, including financial risk, we don't just think about it, we also prepare for it physically. body and brain fuse as a single functioning unit. So he talks about when traders go on a winning streak and have the biological response known as the winner effect. When males enter competition, their testosterone levels surge, increasing their hemoglobin and hence their blood's capacity to carry oxygen, and in the brain, increasing their confidence and appetite for risk. The winner emerges with even higher levels of testosterone, and this heightens his chances of winning yet again, leading to a positive feedback loop. At some point in this upward spiral of testosterone and victory, however, judgment becomes impaired. Effective risk-taking morphs into overconfidence, and traders on a winning streak may take on positions of ever-increasing size and ever-worsening risk-reward trade-offs. What happens to traders' biology if these positions blow up? Their stress response goes into overdrive. The uncertainty people feel during a crisis can raise stress hormones and promote feelings of anxiety, a selective recall of disturbing memories, and a tendency to find danger where none exists. The stress response may foster irrational risk aversion, impairing a person's ability to manage positions taken on in more optimistic times. In short, traders' biology may cause them to take too much risk when they're on a winning streak, and then too little when the market needs it most during a crisis. So just think, based on that, if you allowed yourself to risk any amount of money on any of your trades, when are you likely to be taking your biggest risks and therefore take your biggest losses? It would come just after a winning streak, when your confidence is at its peak and you're risking more just before you end up losing. Now, what I tend to find is that when you do take that loss after a winning streak, most traders, if they're risking any amount, won't reduce their position size down because of the contrasting effects. They get used to using big position sizes and their position size now doesn't reflect their lower amount of capital, so the loss becomes even bigger. And then of course it's like what John Coates says, they start going the other way and become irrationally risk averse and not wanting to actually open trades in the right way. So what this means, if you look at your P&L, is that you'll build up in this sort of slower increments, and then as it starts to build up a little bit faster, you'll encounter a big drop at the height of your confidence before going through that slow climb back up once again. Instead, if we have a 2% maximum risk as the cap on any trade, it means that our positions will be nicely contrasted. None are excessively higher or lower percentage-wise. Now, in reality, with the Duomo method, we recommend that traders use a dynamic position size for each trade and decide their own upper limit for themselves based on their risk profile and other factors. But we don't really recommend going above 2%, but you can choose where that upper limit is. And if you're one of our premium members, we recently had a live stream session in our app where I explained how to choose your position size for each trade, what factors you need to take into account, how you need to assess the trading situation. And like I said earlier, if you're not one of our premium members and you don't know about dynamic position sizes, you can find that linked up here. But I want to know from you in the comments, how do you choose your trade position sizes, and what's the worst experience you've had with it? And also, what's the best experience? Any funny stories? You know, I have to tell you, the reason that I think that trading is the best job in the world is because it's just so fascinating. It's not just about discovering what happens in the markets and why the price moves the way it does, but also the psychological and physiological changes that happen in us as traders. It's like the biggest puzzle in the world, and the more you can fall in love with the challenge of figuring out small pieces of it here and there, the better you'll do and the longer you'll be around in the markets. But for now, just gently hit that like button if you enjoyed this video and found it useful. And don't forget, there are not one, but two channels to subscribe to. There's this one for trading lessons, and we have our brand new channel, kind of brand new, it was launched in December, our channel Market Movers for financial news and fundamental analysis. It needs a bit of love right now, so please bring your comments and likes there as well. I'd love to see you over there. Thanks a lot for watching. You'll find all the buttons on screen. I'll see you in the next one. Take care, guys.